This is Ken Boyd with St. Louis Test Preparation. Here's our website, St. Louis Test Prep. The problem I'd like to present today is I'm calling Advanced Accounting 21C. It's a dissolution of a partnership, and it's the same treatment that you would have for a joint venture. So I'm doing these in the same way. This was sent to me by a student, and I thought it was a good problem. So Lane, Morris, and Newman form a joint venture. And two of the partners, Lane and Morris, contribute merchandise. And specifically, Lane, and I'm going to call them partners. One partner contributes $22,000 in merchandise. Morris contributes $30,000. So on the records of the partnership, we would recognize an asset merchandise, and we would credit to increase capital accounts for Lane and Morris. We have our other partner, Newman, who in this case is going to serve more of a salesperson role. Newman sells $80,000 worth of merchandise on account, meaning it becomes a payable or a receivable, from March 1st to June 1st. So as a company, as a partnership, we credit to increase sales $80,000, we debit to increase receivables. Now, of those sales, here's what happens to the cash collections. Okay, we don't collect all of the sales, $80,000 in cash. We collect $76,500 in cash. We give discounts of $13.50, which reduces our sales. You could call it an expense or reducing sales. It has the same effect either way here. We recognize bad debt expense, $21.50 for people who don't pay us, and we credit to remove the payable for the cash, the discounts, and the expense. Now, Newman, who's our partner, who's a salesperson, gets 5% as a commission on the gross sales. So if I take 80,000 in sales in blue times 5%, I get the commission, which is $4,000 to Newman. And you'll note off to the right here, I put before sales, discounts, and bad debt. So as a partnership, we debit to increase commission expense, and we credit Newman's capital account. Newman then goes on to take some of those cash collections as somebody running the partnership and paying expenses. I just debited miscellaneous expense and credited cash. We're also told in the problem that because Lane and Morris contributed equipment, they earned 6% interest on their original investment, which was that merchandise that they contributed. The idea being that they could have invested that capital anywhere and gotten some sort of return, so let's at least pay them an interest rate on their original investment because they could have taken the capital somewhere else. The partnership only lasts for 3 months, so what I did was take the original investment times 0.06 times 3/12 of a year, and I get 3,300. So if I clicked on Lane, for example, you would see the lane is going to be linked with the 22,000 that Lane invested, and Morris's interest would be based on 30,000. That's the only point I'm trying to make. So we recognize interest expense debit. We increase both of the partners' capital accounts for interest on their capital. Now the venture is terminated, and we have some unsold merchandise that's returned to the people who contributed it. So the capital accounts go down for Lane and Morris, and the partnership credits to reduce an asset account called merchandise. The issue with this case study was the cost of sales was not identified. So I simply said I had to assume that the cost of sales was the total merchandise our partners contributed, that 52,000 less the roughly 13,800 that was returned, and so that's how I got my cost of sales. So if we go back up to the top, and we see what our partners contributed here, 52,000, and then we deduct the $8,800 in merchandise that was returned. I call that my cost of sales because I'm assuming they sold everything except for the merchandise that was returned. So we reduce merchandise credit $43,200 we have cost of sales as an expense. And now we decide to close the partnership. So we need to compute profit. And the way we do that is we close the sales and expense accounts and we take the difference and put it to net income. We debit to reduce sales. We credit to reduce sales discount and all the other expenses. And what I'm left with to make debits equal credits is I need blue minus green, I was right. Net income must be 9,000. I'm told in the problem that 9,000 in profit gets evenly divided among the partners, so we debit to reduce net income and we credit all those capital accounts. So we have ending account balances for the partners, and in fact, those are linked to the T accounts down here. So here are each of the partners' ending capital accounts. The way we wrap up the partnership is we debit to reduce all the capital accounts, ending balances, and we pay them cash because all we have left is cash. All we have left is cash. So when you unwind a partnership, the last transaction is to debit to reduce capital and credit cash. So what we see happening is entry number 17, we debit all the capital accounts, debit, debit, debit. We credit cash, and if you look at all these T accounts, you'll see that all the balances are now zero. All the income and expenses zeroed out. And also, a little more complex, but all the capital balances are zeroed out. And finally, cash is zeroed out. So none of the accounts have any balances, which is why I suggest that you do this in T accounts. So once again, the key to this problem of liquidating a partnership is the same thing for a joint venture for the most part. We debit to reduce the capital accounts and we credit cash. So what we just did was we just explained how you can liquidate a partnership or a joint venture. That's as far as we'll get on this topic right now. Here's the homepage for St. Louis Test Prep. You'll find our accounting video textbooks, which include a practice exam and full instruction using Excel templates. Those are here. And of course, you'll also find video links to all of the YouTube videos by topic. So for example, if you want all the intermediate account videos, they're right here. Thanks very much for watching, and we'll see you next time.